I once heard a saying that by the time a fund manager realises he adds no value, he's too rich to care. Every successful fund manager at some point has to ask themselves whether they want to maximise the returns for their clients or they want to maximise the money going into their own pocket. And if you're running an Australian-focused fund, that number is usually around $1 billion. There's actually plenty of research that shows small cap managers in Australia add value, but it becomes much, much harder once you've got $1 billion to invest. So that's why Ron spoke about it earlier. That's why we've got passive funds, our ETFs, that are absolutely low fee and the fee's locked in, and why we've got active funds on the side as well. So for those of you that don't know me, I worked for 10 years at Intelligent Investor, which is our online subscription business. And for 5 of those years, I was the research director, where our model portfolios did about, I think, 5% per annum better than the index. So it was a good time to be an investor. So now I run our growth and income funds, which are essentially just those model portfolios with real money in them now. But today I want to talk to you about the launch of our ethical fund or ESG compliant fund, whatever you want to call it. Because people aren't thinking enough about this stuff, and our view is that over the next 5 years, we won't actually be talking about ESG factors or ethical funds. It'll just be a normal part of our investing process. And as I'll talk to you about today, it actually goes hand in hand with our Intelligent Investor investment process anyway. But if you're not thinking about this stuff, you're really putting your portfolio and your retirement at risk. And there was a great example late last week. I mean, this stuff is just snowballing. There's barely a day that goes by where we don't see a big announcement on these risk factors. Imagine you were the CEO of Woodside Petroleum. Last Friday morning, you got up, you thought, great, it's Friday, I'm going to come into work, I'm going to get my days done, and I'm going to have a great weekend in Perth, the weather's nice. So you rock up in the morning in the office in your car park in your BMW, and the first thing you read online is an announcement from the Western Australian EPA, which is telling you that they want every oil and gas project in Western Australia to have zero emissions. So if you're the CEO of Woodside, remember you've got tens of billions of dollars at stake in massive projects, and your bonuses and remuneration is tied to this. And now, at the absolute least, if the company was to comply with this essentially zero pollution, if you like, it would increase the cost and reduce the returns of the projects and your bonuses. At worst, it might actually eliminate the need to do the project because they might not be viable anymore. So you can imagine you've had a pretty shit day, you've had the media on the phone all day, and you might have even seen the comments in the Fin Review and elsewhere. And basically the CEO of Woodside said this is regulation gone mad. And so you come home and think, finally, I'm at home, enough of this rubbish, I'm going to have a nice weekend. And so you go to sleep, and what's the first thing that you read in the financial press on Saturday morning is the Norwegian Sovereign Wealth Fund, which made all its money out of the oil reserves in Norway, has said that it's drastically cutting its exposure to fossil fuels. And so it caused about a 3 or 4% decline in share prices of oil and gas stocks across the globe. So then you had to sit there all weekend waiting for your share price to open up on Monday morning, and it went down 4%. So the point I want to make to you today is I hope to convince you to invest in our fund, but even if you don't want to, you need to be thinking about these ESG factors because they are very real, they're snowballing, and this is not a fad. So I won't go through all of this. I'm going to talk more about these individual things as we go along, but I'll just read them out. So I'm going to talk about returns very shortly because I think the first thing that people think of if they have to invest with being compliant of ESG factors or ethical factors, then they're going to suffer lower returns. And I don't believe that's the case, and I'm going to show you some numbers why. Now, I've told you this snowballing, it's increased, ESG factors are increasing the risk for businesses anyway. We're seeing more investors becoming activists, and we're seeing the fallout of the professional CEO, which is definitely something I want to talk about. And we're seeing governments getting involved, and I think ESG will become the norm. So just quickly, I want to talk about the way we're putting the fund together. And all we're doing is putting a negative screen on essentially the ASX 300 list of stocks. So we're just going through and looking at what the industry standard is of what is not non-ESG compliant stocks, and we're just taking them out and then putting a portfolio together with the remaining stocks. So standards are evolving all the time, and no doubt what's ethical today may not be ethical in the future. We'll just adapt as the industry adapts. But you can see at the bottom there, the most common ones that we talk about are fossil fuels, payday lenders, alcohol, gambling, junk food and beverages, supply chain concerns and armaments, but that's not an exhaustive list, there's plenty more. Mostly in Australia, it tends to rule out the resources companies, and we've got quite a decent handful of decent quality gambling companies. If you look at any ESG or ethical fund in Australia, you will see this table on the website, just about guaranteed, because there hasn't been a lot of research done on ethical funds because they haven't actually been around for very long. And so if you look at the top row there, it says the average responsible investment fund. This was produced by an organisation called the Responsible Investment Association of Australasia. And they say over the last 10 years, if you were in the average ethical fund, you would have earned 5.4%. And if you're wondering why that's quite low, it's basically because the 10 years, it's almost 10 years to the day. In fact, it was 7 days ago when we hit the low of the GFC. So then they compared it to the average large cap Australian shares fund, which only did 3.5%. So that's almost 2% annually per year better you would have done over a decade, according to these numbers. And you've just had Alan and Ron show you what a dramatic difference fees make to your investment returns. So imagine if you could just increase your returns by 2% a year, obviously you would do it. And then it compares it to the average accumulation index, Australian share market, which has done 4%. So even it's 1.4% above the market. The problem I've got with this slide is that it only incorporates the last 10 years, which goes hand in hand with the longest bull market in US history. And so I'm guessing that if you had a look in these ethical funds, you'll probably see a really, really big helping to companies like ResMed, CSL, Fisher & Paykel Healthcare, and these types of stocks, which are all trading on around 30 or 33 times earnings. So about double the price to earnings ratio that they've historically traded at. So I don't think this 10 years is a particularly good period to be looking at because I think the numbers are inflated. So I thought I had a bit of a genius insight, and I thought, where can I actually find some better numbers that will give me a better idea of whether we can actually make more money investing this way? And I thought, brilliant, we've got 420 recommendations at Intelligent Investor going back to 2001. Why don't I just go through the list, remembering, as Ron said, it's been audited every year. So every recommendation has been audited. Why don't I go through the list of 420 stocks and tick which ones would pass our ESG filters and which ones wouldn't, and then I'll have a look at the difference between the returns. Well, the difference was for the ones that would have got past our filter, the average return was 14.8%. And the average return for those who wouldn't have passed our filter was 10.1%. So if we had have adopted this through our journey at Intelligent Investor back to 2001, we would have done a much, much better job for you with the 60-odd recommendations that didn't pass the filter, which are almost 5% behind our other recommendations on a per-year basis. So you could have called me sceptical when Ron started talking to me about this 6 months ago. And at InvestSMART, as you can see, we're a pretty professional bunch with our formulaic slides, but I wish I could have put on the very front slide the response from one of you guys to our initial launch of the ethical fund. It's a very emotional idea, and this guy basically said we can shove it up our backside in no uncertain terms with a bit more colourful language. And I was sceptical as well, but when I went back and did this, I think the best thing that could give you some sort of lead of what sort of returns we can produce, it's going to be using our Intelligent Investor process that's been, as I said, going back to 2001, and it clearly shows if we'd avoided some of those non-ESG compliant stocks, we would have done much better. And for those of you that were Intelligent Investor subscribers that might remember back in 2009, we had recommendations in Timbercorp and Great Southern, which were complete zeros. And we were also up and down the credit structure, so we recommended all the income securities as well, all zeros. And I thought they were unethical businesses anyway for environmental reasons, and it's really just a tax dodge. But then Ron said to me, yeah, but they grow trees, so people might argue with you. I said, all right, I'll put them in the ethical bunch. So all those zeros are actually incorporated into that 14.8% return. So the almost 5% gap would actually be wider had I put all those recommendations in there. So to me, this was really a turning point for me in terms of believing that we can actually do much better versus the index with an ESG compliant fund. There are increasing risks coming from ESG concerns, and this is what I want to talk about. Even if you don't want to invest in our fund, you need to be taking this stuff seriously because this stuff is snowballing and it's becoming more important every day. We've seen the Hayne inquiry. So if you're a company or working in an industry that's not ticking off on these ESG criteria, then the government is coming for you. And it doesn't necessarily mean that your business is going out of business, but it's probably going to mean lower profit margins, lower profits and lower dividends. And when we've got an environment where interest rates are very low and the future expected returns of just about every asset class is way below average, we need every tool in our kit bag working for us. So we can't expose ourselves to these sorts of risk factors unnecessarily. We're seeing the aged care inquiry going on now, which needs a decision by October. And there's already been calls for other industries to be put through this, and the gambling and pokies industry is one of those that people keep highlighting. But if it's not the government coming for you, as in the case, I've also mentioned renewables replacing fossil fuels, so we've seen the government is very anti-coal. All right, so these things are changing. So if the government's not coming for you, then competitors with superior products that do tick off on these ESG criteria are coming to market with better products. So I just want to talk about Coca Cola for a moment, because if you followed Warren Buffett at all, you'll know he really became famous with his investment in Coca Cola at the end of 1980s, and I think it was probably his best listed stock market investment. He made an absolute squillion out of it. And he always talked about Coca Cola as being the greatest quality business, because every year they could put up the price of a can of Coke by 1 or 2 or 3 cents, and it wouldn't matter to any of us. We'd continue to buy our can of Coke. It made no difference to us. And to him, that was an example of pricing power. Okay, and that's really what distinguishes the good businesses from the rest. But what's happened over the last 3 or 4 years is that revenue from selling Coke has started falling, along with all other types of soda, Fanta and the rest, because we're starting to think healthier, and we know the damage that a lot of the sugar intake can do. And I know you've probably seen those documentaries with the US kids with no teeth, drinking 7-Up or Mountain Dew, and this is just really bad stuff, right? But Coca-Cola are onto this, and they thought, okay, we get it, we're going to be selling less Coke. So what did they do? They started selling bottled water. So it was a stroke of genius, all right? And that's continued the growth going for the business, and it's been a great management decision. But what's the problem with this now? Can't get a noise going. But it's the plastic bottles, all right? The plastic bottles are now a terrible environmental consequence that we don't want. So now the company, again, the governments are coming for companies like Coca Cola by reducing their profit margins with things like sugar taxes and other recycling taxes. Okay, so these once great businesses are now sunset businesses rather than the sunshine businesses we want to be in, like the C-Cells and the ResMed, that are going to be good businesses for years to come. One of the best things that happened recently, and I don't think the media made enough of this, although Alan wrote a really nice article about 3 weekends ago when it happened about it, and that was in December last year. The NAB board, National Australia Bank board, had an 88% vote against its remuneration for management. So was there any surprise then during February that its chairman and CEO were sacked? Probably not. This was the first time that shareholders had really had a massive impact on the CEO and the board at a major Australian business. I thought this was absolutely a huge thing just with that fact alone. But what I absolutely loved was that Andrew Thorberg, who had a $22 million worth of shares, that normally he would have got the golden handshake payout on his way out the door, the board said, no, we're not paying you that money. You don't deserve it. You haven't delivered the performance. And so he didn't get it. Like, I couldn't believe this. It's the first time I've ever seen this happen. And it's clearly telling you that something is changing. All right? Again, this is just the G factor in the ESG factors. And if you look at all these incidents isolated, then you're missing the full picture because you're just looking at whatever the detail is of that particular event. But if you tie all this stuff together, actually what you're seeing is a much more ethical push to the way we do business and the way our businesses run and the corporate culture behind them, which is really important because the millennials who are going to be running these companies in the future and our future investors, they have very different attitudes to our generation. There's what I thought was an amazing statistic on a survey done not long ago in the US. And remember, what's made America great is not Trump, but its capitalist system, all right, that's worked so well and just created so much wealth and taken so many people out of poverty, although obviously it's left a lot of people there as well. But millennials are onto this, and so they did a survey, and 64% of them said they want a more socialist economic system, which I just thought was incredible. But that's what's coming our way, and that's what's going to help change our corporate culture. So again, if you think this stuff is just a fad, you're wrong. So I've got this quote from Winston Churchill, says, to improve is to change, to be perfect is to change often. So the important point I want to make with this slide is that just because we're launching an ESG compliant fund or an ethical fund doesn't mean we're changing our investment process. Just because a company ticks the ethical boxes or the ESG boxes doesn't mean we're going to buy it. It still has to pass all our normal qualitative and valuation input that we put through the intelligent investor process. So this is really just another screen to reduce risks from the list of stocks that we can choose from. There's this great quote from a guy called Jesse Livermore. There's a book you may have heard of. It's called The Reminiscence of a Stock Trader, I think, or a Stock Operator. And it was about this guy, Jesse Livermore, that was around during the 30s. And he made and lost 3 fortunes in his life, and he ended up killing himself at the end. I think he was about 60. But he actually had the way we invest sorted out about 80 or 90 years ago. And he said, it was never my thinking that made the big money for me. It was always my sitting. And if you've been an investor for a long time, you know how hard it is to actually do nothing. 99.9% of the time, the best thing I can do for your money is nothing. And there's not many jobs I know where you're going to work and the best thing you can do all day for your company is to do nothing. But it's actually very hard. So I just want to talk very quickly, for those of you that aren't familiar with the intelligent investor process, I've tried to just summarise it here. And we're always looking for high quality businesses. We're not, occasionally you find the cigar butt, the really hated, horrible, statistically cheap thing, but we've always generally preferred quality because, using CSL as a well-known example, you just get that compounding over time and it minimises your taxes. And again, as a fund manager, the best thing I can do is put your money in those sorts of companies and then just stay out of the way. We're looking for high insider ownership, and I've got a slide coming up to show you why that's so important, particularly to me. We want long growth runways because we don't want to be in those sunset industries. And these days, the price of being on the wrong side of technological change is a rapid decline in your business. And as always, we want to buy 50-cent dollars, but in the market like we've got, we need to be very pragmatic about that and stick to quality. And this is really not the time to be sticking your neck out to buy low-quality businesses that look statistically cheap. And that was the lesson we learnt from Timber Corp and Great Southern in 2009 or 2008 when we found it hard to find value then. On the bottom there's, some of you may recognise the idea of special situations, but it's a bit of US jargon. And basically it just describes a few common instances on the stock market of where we can find value, because with something like a Woodside or a Woolworths or a Coles, the market tends to be very efficient about the valuation. And as value investors, we really only make our money when we find the market's mistakes and we invest your money in those undervalued securities. But in special situations, you often find that the market is when it's at its least efficient. So when it's most likely to make a mistake handicapping the business. So whenever you look for a company, you may remember about 5 years ago, Steve Johnson and I did this roadshow, and Steve was talking about a company called ServiceStream, which I think is up about 12 or 13-fold since then. And at the time, the performance of the stock was terrible. A whole heap of people were very frustrated. They sold out. They didn't want to be part of the capital raising, but the company raised capital and diluted existing shareholders. They sacked the CEO and they brought in a new guy called Lee McIntyre, who was an internal appointment. Now, no one knew anything about Lee McIntyre, but if you talk to some of the people that invested in ServiceStream today, they think he's arguably the best CEO in Australia. But back then, no one cared. Everyone was just so pissed off with their returns and the loss of money. They didn't care. They didn't want to stick around. No one wanted to see who this Lee McIntyre was, and they just didn't care about the business. But that's precisely the point, at that point of maximum pessimism, where if you can do your research and you can get comfortable with the new CEO, when you're most likely to find a bargain. So I'm looking for these situations where there's a new CEO, a recapitalised business, a spin-off, which we're seeing more of in Australia. So the funds management business of the banks look like the next ones, and companies with hidden assets. So features of their business that don't screen very well on a computer system. So if you're a value investor and you're all about Warren Buffett, you're looking for high return on equity, good stable earnings growth, low volatility in the earnings, good dividends, at the moment all that stuff is priced up here. So we need to work much, much harder to find value, and I've got an example coming up. These charts, you don't need to know the details here, but this is just what I want to describe to you. To me, it was important well before we started talking about ESG factors. But to me, the best corporate governance is having the founder running the business with his reputation on the line. There's just something about people who run their own business, excluding Harvey Norman, that tend to think very differently about their businesses and think about the business where it's going to be in 10 and 20 years. And so on the left-hand side, this chart only goes up to 2014. Again, you don't need to worry about the details, but you can just see the two lines, and the top line looks at the S&P 500 companies, and the top blue line is the founder-led companies, and you can see the share price performance of those select group from 1990. And you can see it's absolutely killing all the other stocks. Now imagine if I had this chart up until today, where over the last 5 years, the stocks that have absolutely driven the US market are Google, Facebook, Netflix, Amazon, all these massive technology companies that have gone up multiple times, all founder-led businesses. Imagine what that chart would look like. Now on the right-hand side, what it's telling you is it's not just technology stocks. This is a phenomenon that happens across all industries. There's just something about founder-led businesses that generates much, much higher returns than the average business over time. And if you go and Google this same idea for European companies, you find exactly the same thing. There's this dynastical wealth in these businesses that have been owned by families for generations, and they're thinking about handing it down to 1, 2, and 3 generations ahead. They think very long term, they don't take on too much debt and put the business at risk. They're slow to make decisions, but they act decisively when a bargain comes along. This is what happens when you don't have founder-led businesses running your business. Founders running those businesses. Now, we could sit here for a week and go through all these headlines about guys that run BHP, 50 billion shale oil blunder. One of the first memories I have as an investor is, I think it was the hot bricketed iron plant that was always a problem for BHP. And they've had heaps of them since. Rio Tinto gets a mention, it was very unethical in some of the stuff it did, and AMP, all these stocks that you're very familiar with. Now this slide didn't go down very well in Perth, but I was just trying to pick 2 companies that you know well, and CSL versus BHP. And the key point here is that if you look at the average ESG compliant business, it just tends to be a much better business than the others anyway. So if you're looking at trying to put all those factors on your side about what's going to deliver you outperformance over time, you want to buy the good businesses and let the compounding take over. Buying something like BHP, I know it's found religion at the moment and it's returning all this cash to you, but I guarantee at some point they'll realise that their earnings are at risk and they're going to have to go back to digging holes, which is very expensive. So this slide is really just telling you that ESG is becoming the norm. I think when we come back in 5 years' time, we won't really be talking about ESG factors on their own. They'll just be a normal part of the investment analytical process. And ESG is really coming into its own at the moment because we've got changing societal attitudes, there's increasing pressure on governance, reducing risk is just good business, and Woolworths, for example, is looking at selling its pubs business because it's got the exposure to pokies. So you can see CEOs are taking this stuff very seriously. And I guarantee you things will change when their own remuneration incorporates some of these factors. And at the best companies, they already are. So Dulux is one that has to deal with toxic chemicals, so it's one that you really want to be focused on the environmental side of things especially. And if you go through its annual report, there's a whole section in there showing you that they're measuring all these things and how seriously they take them. And if you have a look at the CEO's remuneration, 10 to 20% of his annual remuneration is down to these factors. So that's what we want to see. We don't want to see small talk about this stuff. We want it to impact management's remuneration. So what's in it for you? So the launch of the fund, it'll be easy to invest in. It'll be listed on the ASX just like a regular stock, so you can buy and sell it just like a regular stock, but it'll be a ready-made portfolio where I spend all that time doing nothing to find stocks to put in it. It's the same intelligent investor long-term approach. It's focused on high-quality businesses. The long-term holdings that we help will minimise tax. So the last thing we want to be doing is making our brokers rich. Have semi-annual distributions and the same regular reporting and candid communication that I think Intelligent Investor and InvestSMART are known for. And we've got a fixed management fee and no performance fee. And I know the first question you're thinking is, why can't you cap the fee? And the reason is because part of the ASX listing requirements means that we can't charge every individual different amount, so we have to have a fixed fee, so that's 0.97%. But most importantly, the biggest fee that eats up your returns over time is the performance fee, and we don't have one. So just very quickly, for those of you who like looking for stocks and buying things for your own portfolio, I haven't picked this stock because of its ESG credentials necessarily, but just because I think it's a good idea, of the sort of idea that's hard to find, it's hard to screen for, but even when we're deep into a bull market where everything's pretty expensive, you can still find value if you know where to look. So this company, the code is TGP, it's called 360 Capital, and you can see on the left-hand side, going back to the March in the GFC 2009, my mate and I thought we were pretty clever, and we bought into this stock, and we enjoyed that nice little ride over the next 18 months. We made about 70 or 80% on our stock. And the story was that you might remember back then there were all these A-REITs trading at massive discounts to the underlying property. And this guy, Tony Pitt, took control of this business, which at the time was called Trafalgar, same code though. And he said, I'm going to narrow that gap, I'm going to get the performance of the properties up by increasing the rentals, the rental prices, get the occupancy up, then I'm going to sell off the properties and reduce the gap. And he did it. He did exactly what he said he was going to do. And so I thought, great, we've made our 70 or 80%. I don't need to be hanging around this stock anymore. We'll go and find the next great idea. And so I did. And so that huge run you see in the stock from about 13 or 15 was my genius idea to stay away from. So what did I say about doing nothing? So this guy, Tony Pitt, really took advantage of the recovery in property in this country after the GFC. He did a couple of great deals and created a tremendous amount of value for shareholders. So now, and remember, this is a guy who owns a quarter of the shares in the business, so he's absolutely aligned with shareholders. This is a guy who runs the business, lives and breathes this business, and who owns the business. You don't need to worry too much about the details on this slide, but what it's telling you is that since the Hayne Commission in particular, the banks have been withdrawing funding from certain areas, and one of those areas is small property development. Now, this is perfect for companies like 360 Capital because they want to lend to situations like building a $13 million doctor's office in the suburbs. It's very small, very low risk, and the banks don't want anything to do with it, so normally you'd get, say, an 11% annualised return or maybe over 18 months and you get your money back. These days, when you lend money to these situations, you're earning 15%. So it's an extraordinarily high return for fairly low risk and for a short payback period. Again, don't worry about the detail on this slide, but I think you'll do just fine if you own this stock over time. And again, this is just general advice. I'm not telling you to buy it. It's a stock that I've got in all our funds, and it's certainly in our ethical fund. But at the moment, I think we'll do fine over time with Tony running this business. He'll invest. So what he's doing is, when you're at the start of a recovery cycle, so 2009, you want to be in the equity because that's where you get the maximum bang for your buck as things recover. But now we're at the absolute opposite end of that cycle. So now what he's doing is, rather than providing the equity where you've got very little protection against something going wrong, he's actually lending the money where you've got covenants to protect you. And so if anything goes wrong with the $13 million development of the property, then essentially Tony and 360 Capital have first rights, and he can go in there, put in the money that needs to, and get it done if for some reason things go wrong. So to me, there's very little risk in doing this. At the moment, you're paying absolutely nothing for what I think is a potentially huge hidden asset that, if you look at the share price, is worth zero, and I don't think it's worth zero. So what Tony's doing is he's making these investments and making these loans, but he's setting up a funds management business on the side so other third parties can come and take advantage of those 15% annualised returns that I spoke about. And there are lots and lots of people at the moment who are looking for 12 to 18 months paybacks with 15% annualised returns. And so there's some good news last week where 360 Capital is launching 3 new funds for people to invest in. And my guess is you don't go and launch funds unless you think you've got investors lined up and the projects lined up to put the money into. And at the moment in the share price, you're paying absolutely nothing for this. So this is a $200 million company that one day could potentially be, there's no reason why in 5 or 10 years it couldn't be managing over $1 billion worth of projects. Now this stock is not going to stay at $200 million if that happens. But if it doesn't happen and the funds management business is a complete failure, well, you're not paying anything for it. In the current price, you're paying absolutely zero for it. And I still think you're doing well. And to me, that's the classic value investor, intelligent investor stock. Heads, we win lots, and heads, we don't lose too much. Thanks very much for coming and look forward to the questions.